This is the Asia Trade. I'm Shery.
And I'm Haidi Stroud-Watts. The top stories this hour. A positive lead-in for Asia as investors gear up for earnings season and Jay Powell's visit to Capitol Hill. TSMC's US-listed shares briefly surpassing $1 trillion in market value.
Also ahead, President Biden pushes to end Democratic infighting over his White House campaign, telling lawmakers and donors he's determined to stay in the race.
Plus, how Elon Musk's own brand of cancel culture is thriving at SpaceX, with regulators in retreat.
Another record high for Wall Street. What are we talking about? 30s plus something, 35th? At this point, I wonder if we have to keep counting these fresh record highs for U.S. stocks. Of course, we have seen that enthusiasm over artificial intelligence, not to mention the expectations of 2 Fed rate cuts coming. Still, I gotta say, the gains overnight were a little bit muted. We're talking about a little bit of caution in markets this week. Of course, Heidi, you mentioned Powell's testimony to Congress, but we also have the start of the earnings season. So we're watching the latest coming out of these companies very closely. NVIDIA climbed in the overnight session because UBS Group raised its target, although we do see more trouble ahead for Boeing. So that's kept really the rally in check.
Yeah, it's interesting because we have sort of, I guess, a little bit more of a retreat, if you will, even with this rally. Maybe with this rally, I should say, maybe there is a little bit of caution starting to creep in, given it is a big earnings week, it is a big Fed communications week, and of course, this sort of political risk is creeping in there as well, right? But take a look at the setup here in Asia. We've got, I would characterize this as sort of modest optimism, a mixed start. We're seeing that cautious trading ahead of Jay Powell's testimony to Congress and earnings starting to flood through from the US as well. Seeing equity futures in Australia looking like we'll see some muted gains as trading begins in the next hour. We're seeing Nikkei futures also modestly high, about a 1/10 of 1%. Watching China as well, of course, sort of still watching the communication challenges that are still piling up for the PBOC with these open market operations and what the bond market is doing at the moment. We're seeing that equity market continuing to extend those losses. Dollar China pretty steady at the moment, but when it comes to the Aussie dollar, we'll be watching out for the potential for further upside there, potentially 2024 highs to be revisited. But Shery, as you were mentioning, record high after record high. We spoke to Mike Wilson overnight, and he certainly thinks that there's room for not an insignificant correction.
I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period and it's going to be choppy.
And our next guest says Haven assets will be highly sought after in the second half of the year. Joining us now is Hebe Chen, market analyst at IG. Hebe, great to have you back with us. Are you seeing any changes in risk appetite so far?
Good morning, Shery. Lovely to be back. Yes, absolutely. I think that very few of us that stepping into the second half of this year that expecting a smooth selling, because we know that we have known a sort of unknown unpredictabilities in the market. And based on the last week, the first week of the second half of the market, we do see quite a bit of the shifty, quite subtle change in terms of risk appetite. For instance, we're looking at the safe haven asset, for example, the silver, the copper, the gold prices has been surging quite dramatically in the past week. By contrast to that, is we're seeing quite high risk beta assets, the cryptocurrencies dropping quite significantly. Of course, there's some of the other side reasons to drive the change there, but I do trust that as we're getting into the quite uncertainty time, that this quite highlights clearly that the safe haven or like safe quality will become a quite sought after quality when the investors looking into that which asset and allocation for the capital.
How important will this earnings season be as opposed to, say, where the Fed goes from here? Because we also have, of course, June CPI numbers coming out of the U.S. this week.
Yes, exactly. So the CPI, everyone's been holding the breath for the CPI, and that's not only because that we're expecting to get more update from the inflation, but also the quite significance coming from that is that we're marking a full cycle since the previous CPI that has helped the Fed to sort of coming out with the statement that they're seeing that this inflation process has picking up. So what the market is expecting is a 0.2% of month-over-month change. Well, a bit high from the last month, a flat, no change. But what most important to the market is to seeing this trend, this inflation process has getting stabilized and then forming a trend for the Fed to starting talking about the cut maybe as early as September meeting.
Hebe, I'm watching China at the moment. Obviously, we've had sort of a flurry of communication from the PBOC, some more of these open market operations. But I do wonder, we're seeing this extended run of weakness for Chinese equities. Is this the new normal when it comes to, perhaps not much further downside for the economy, but certainly no great upside risk either?
Well, yes, you're right. I think the equities in China is definitely at the crossroad this week. We're having the China's inflation, always quite significant data of the month, but also is what everyone's waiting for is the next week's CCP's meeting to expecting some of the reform or potentially press the reset button for the Chinese economy. So at this stage, if you're just purely looking for example, the Hang Seng Index, it's only about 1 to 2% away from reverse the uptrend since end of January. So it looks like quite obviously the market's been waiting for that last mile to confirm that decision-making meeting, also the economy data to either reshape or either continue the optimism for Chinese equity. So I think this week is critical as well as the next week. We're pretty much likely to seeing a big change in terms of risk appetite for the Chinese equity.
Right, and you're of course talking about expectations ahead of the plenum. What sort of policy measures do you think we could get that would actually make a meaningful difference to market sentiment?
Well, based on, for example, if you're looking for the Chinese inflation data, even though we're seeing that the inflation data has been a positive area for the past 4 months, but if you're looking carefully into the monthly one, you can see that there's still not yet a quite sustainable stabilize picking up in terms of a domestic consumption. I think that's one of the areas that I will be looking at, whether or not the policy can really recover that area. But of course, property sector is another one that everyone's been so waiting for, that if seeing that Chinese top policymaker could reset or fix the engine, which has been contribute about a quarter of Chinese GDP in the past 2 decades. But apart from that is any other thing that new drivers that they could introduce to forming the new engine for Chinese economy. I think there's a lot of things that we can looking at. The expectation for a groundbreaking is probably not that high, but what most important is whether or not the policymakers do showing their keen attitude to revive the economy and to making the investors into the market feel the confident about the months to come, also the year to come.
A recent Bloomberg survey showed that investors were turning back to Chinese stocks, not to mention Indian stocks, and away from Japanese stocks, which had been really favored in the past year. Do you expect that trend to continue, or that sentiment to continue, if we continue to see the underperformance of Japanese eco data?
Well, I think there's two reasons for that sort of underperformance. One, if you're looking for domestic drivers, is the Japanese stock has been picking up so strongly since early this year because, one, that everyone expecting Japanese economy could sort of continue the momentum from last year. But based on the GDP for the Q1, appears that the Japanese economy is still quite struggling. They still cannot rule out the chance of a recession in the months ahead. That's one of the reasons. But in terms of the external reasons, external environment, as I think we mentioned earlier, the uncertainty there, we're still not sure what the global economy was stepping into, that were putting extra pressures on the Japanese economy, which is still quite struggling to recover sustainably. And also, apart from that, is what the Japanese future strategy, which are looking at into the AI or the technology leadership, whether or not they could really coming out as a solid result after this year's sort of the quite challenging years. I think there's all the uncertainties that have been surrounding Japanese stocks.
Hebe Chen, market analyst at IG. Always great to chat with you. We've got some deals news just crossing the Bloomberg when it comes to Australia. This is one that we were watching, the private equity firm Bain Capital having had made that unsolicited takeover offer for the Australian automotive parts retailer Bapcor. That's now been rejected by Bapcor. That non-binding proposal from Bain being rejected to the offer of $5.40 Aussie per share. They've concluded that that proposal does not represent fair value for Bapcor. Says the deal is not in the best interest of their shareholders there. So Bapcor is the parent company of Autobarn. It's a car parts outlet. They do car servicing amongst other things as well. So that $5.40 Aussie per share cash offer from Bain Capital has been rejected. We have seen shares falling almost 50% from about mid-2021. They've had a series of profit downgrades. So it'll be interesting to see if Bain comes back for another go.
Yeah, we'll be watching the market opens in Australia at the top of the hour. But coming up on the Asia Trade, we discuss the post-pandemic tourism rebound in Australia and around Asia. Hear why Aberdeen is overweight on Chinese and Indian stocks for the second half of the year. And we'll look at what's at stake in Narendra Modi's trip to Russia. This is Bloomberg.
The bottom line here is that we're not going anywhere. I am not going anywhere. I wouldn't be running if I didn't absolutely believe that I am the best candidate to beat Donald Trump in 2024.
President Biden there pushing back on calls for him to quit the U.S. presidential race, really working to quell Democratic infighting about his campaign.
Yeah, it really does continue. But let's get some insights now from our politics editor, Laura Davidson. So, Laura, we're seeing, the same kind of note of defiance being struck by the president here.
Yes, this is, been the drum that he's been beating for several days now, saying, look, I am the nominee. I'm not going anywhere. And today, kind of this new line of, look, we're wasting time. We need to unify behind my candidacy, is what he's been saying. However, it is not at all clear that both Democrats and Congress, as well as his donors and top, aides and party people are totally behind that message. There are so far 9 House Democrats who have come out against Biden, saying he needs to step aside. Congress is meeting for the first time since the debate tonight, Monday night, in Washington. So we'll see over the next course of the few days if more Democrats say he needs to bow out.
Yeah, Laura, let's talk a little bit about the wealthy donors, because that's where the money is. How much of an impact could it have on his campaign if they back out from really supporting his bid?
So if wealthy donors stop giving, as many said they have, or they're going to instead give to House and Senate races versus giving to the presidential race, that could have a serious impact on his campaign. It's important to note that Biden is probably not going to step down just because donors say so. However, it could be an important kind of piece of this consideration if he also has pressure from Congress, and if he particularly has pressure from his own family. That's been one of the sources that he's been listening to the most.
What's the timeline here in order not to get into a drawn-out power struggle that could actually affect the November elections?
So both donors and Democrats in Washington see this week as kind of this key timeline. You have Congress coming back. You have Biden, who will be hosting the NATO summit here in Washington over the next several days. There will be, he'll be under scrutiny from foreign leaders as well. So there's a lot riding on this week. At the end of the week, Biden will have what the White House is calling a big boy press conference, and so he will be, taking questions for a long time. This is something that he has not typically done, and it'll be really under the microscope to see, does he have the stamina? Does he have the vigor? Is his speech, projecting that he has, confidence in what he's saying and fully in command of the facts.
Politics editor Laura Davidson in D.C. That'll be closely scrutinised for sure. We're staying with geopolitics, and Indian Prime Minister Narendra Modi has met privately with Vladimir Putin to begin his first visit to Russia since Moscow's invasion of Ukraine. Bloomberg senior geoeconomics analyst Shery joins us now for more. So we're expecting formal talks on Tuesday after this private meeting. China obviously is sort of front and centre within the context of this relationship. What are we expecting?
Well, officially, they've suggested that there won't actually be any major deliverable from this visit. We don't expect any, but I think from India's perspective, it's about a balancing act and continuing this long-standing strong ties between India and Russia. But as you mentioned, China's in the background. So India considers China a threat. They've had border clashes. Russia and China are no limits partners, as they say, and China is providing a whole lot of material to the Russian economy. And so there's a question of how does India balance that relationship with its desire to maintain strong ties with Russia?
How much has India really benefited from the geopolitical complexity around the world, given, of course, that India does want to maintain those ties with Washington, but at the same time, as you mentioned, trade relations with Russia are deep?
Right. So India is benefiting in the sense that Washington and the West in general, but especially Washington, are concerned about China. And Washington sees India as a crucial regional partner in addressing the challenge with China. India, of course, knows this, so they know they have more leeway than they might otherwise have, particularly with regard to the Western backlash against Russia after the war in Ukraine. And so basically what's happened is India has become the most important marginal buyer of Russian oil. They get about 25% of their energy imports from Russia at this point. The West is not happy about that, but they're not going to do anything to stop it. On the other hand, we've also found in the trade data evidence that India is increasing its exports of potentially sensitive or military industrial goods to Russia. So basically, India can get away with that because Washington's not going to do anything about it because of China.
And I do wonder how long they can sort of get away with walking the tightrope on Ukraine, right, after the attack on the hospital and going into NATO as well. It's pretty interesting timing for this relationship.
It's pretty awkward timing, actually, to be filmed hugging Putin on the day that Russians attacked a school, whether by or a hospital, whether by accident or not. But nonetheless, that is India's policy. India is not supportive of Russia's invasion of Ukraine, but they're also not condemning it either. They're basically trying to be neutral, but slightly less neutral in the sense of what they're sending and buying from Russia, and also this visit, which is a big deal. Not many foreign leaders are going to Moscow these days, and Modi is going.
Shery, people, great to have you with us with that context on the Modi visit to Russia, our senior geoeconomics analyst. Other political developments that we're following, the left-wing alliance that won the most seats in French parliamentary elections says it will nominate a prime minister in the next few days. Sunday's vote produced a divided parliament with no clear majority. The left's candidate for premier will almost certainly need to win support from President Emmanuel Macron's group, which won the second biggest number of seats. Hungarian Prime Minister Viktor Orban has met with Chinese President Xi Jinping during an unannounced visit to Beijing. That followed a similar surprise trip to Moscow for talks with Vladimir Putin. EU leaders have sought to distance themselves from Orban's shuttle diplomacy, which comes as Hungary takes over the bloc's rotating presidency. Orban heads to Washington this week for the NATO annual summit. We have more ahead on the Asia trade. This is Bloomberg.
All right, let's get some morning calls ahead of the Asia trading day. And we're seeing bearish signals mounting for Chinese stocks. The Hang Seng China Enterprises Index fell on Monday, declining over 9% from a May 20 high. It is now near the realm of a technical correction.
A rally in Chinese equities that started this year has lost momentum due to an uneven economic recovery. Investors are also not expecting a quick boost from one of China's biggest annual policy meetings next week. Morgan Stanley strategists now saying that investors are feeling no rush to return to the market, with currency weakness and China's macro challenges remaining near-term hurdles.
And Shery, Oaktree Capital Management says highly levered assets within private equity and real estate are promising distressed investors some of the best opportunities in more than a decade. But Howard Marks, of course, a co-founder, thinks that's where the pain will come in the future. Risky corporate borrowers, especially those backed by private equity, have seen a jump in borrowing costs as a result of Fed hikes. And while in the property market, we've also seen the value of commercial real estate falling, while a slow-rolling wave of maturities is underway.
Right now, and I think going into the future, leveraged companies will not be able to renew their leverage as easily, and the cost of doing so will be higher. So that gives us better opportunities than we've been seeing.
Brace for impact. This is what we were talking about earlier about Morgan Stanley's chief U.S. equity strategist saying that investors should brace for that potential correction in the S&P 500 in the coming months. Shery, you were saying we've lost track of how many record highs.
I think it's 30-something, 35th this time. But Mike Wilson telling us more about where he's seeing risks in the U.S. markets.
What worries me is that momentum is so strong and people have a lot more exposure to high multiple stocks than they think they do. And if you have an event that's unpredictable, then you could have a real reset on valuation of 10, 15%. Like, I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period and it's going to be choppy. Now we're hoping that's going to create some opportunity, but like right here, valuations to me look very, very unexciting.
And it's a great point, too, on you might be more exposed to tech than you think, especially if you're sitting in the S&P 500, which is, 30% tech or so. I do want to actually talk about how all of this rolls into price targets. And typically at this point, I would ask you what your year-end S&P 500 forecast is. But I know that you've backed away from those sorts of calls. And it was interesting. If you take a look at Friday, we got some news from Piper Sandler saying that they're actually going to drop their S&P 500 forecasts, that basically it's bad practice. And when you think about that, I mean, are we starting to see the beginning of the end of these big, bold S&P 500 forecasts?
Well, no. What we did is we rolled forward our forecast 12 months in May, so we took away our year-end target. And look, first thing I would say is S&P targets at a certain time and price is kind of silly. But what I would tell you is that the risk-reward from here we think is lower. Like over the next 4 to 6 months, for the same reason I just mentioned, we have volatility probably picking up in the third quarter. I would say your likelihood of upside between now and year-end is very low, much lower than normal. I'd call it 20-25% that markets are higher between now and year-end. Okay, specific target, I don't know, but let's say it's down 10% or so. Then we would get interested. Then we'd be interested to say, okay, maybe there's some things happening at the index level. Where the opportunity remains is at the stock level, at the factor level, okay? And in that regard, we still like sort of growth, but not just quality growth, but like, quality in general, large cap, good balance sheets, companies that can deliver on earnings, and that momentum will continue. It's just hard to find companies that are cheap. So if they were to come in 10%, then we'd probably get interested again.
Morgan Stanley's chief U.S. equity strategist Mike Wilson there speaking on the debut of that show, Bloomberg's Open Interest. Take a look at how U.S. futures are trading at the moment, because we continue to see that extension of those gains that we saw in the Wall Street session. Of course, record highs again, 35th this year. And it's really the question of what Chair Powell also says later this week on Capitol Hill, right? Because what will he say about the labor market? Will he downgrade his assessment after Friday's soft June jobs report is a key question. And is he sort of worried about the easing financial conditions? It would also be a question of mine.
Yeah, he's facing a lot of pressure from lawmakers who are growing impatient as to where we are at when it comes to this monetary policy cycle, where we're seeing rate cuts, particularly as we head pretty close to November. And again, it's that sort of tension between fiscal and monetary that's building, not just in the US, but a number of these countries that have elections or have just had elections.
And then we can't forget the incredible rally around the Magnificent Seven and the exuberance of artificial intelligence, right? All of that really filtering through the markets as we head towards earnings season. We have more ahead. On the Asia trade, this is Bloomberg. I mean, it may not have been an exciting overnight session when it comes to broad levels on the S&P 500. Another record high, really big news there. But it was really TSMC's ADRs that really shot up and took the company to that $1 trillion valuation. Of course, perhaps not surprising given that, as we talked about earlier, that exuberance over artificial intelligence. But we also had a call by Morgan Stanley, which raised the target on the stock by about 9%.
Yeah, we're seeing TSMC just jump from strength to strength, right? We saw earlier it overtook Berkshire Hathaway in June to become the world's 8th most valuable company based on the ADRs, right? It is, I should point out, trading at a pretty considerable premium to its Taipei traded shares. In fact, you're taking a look at the gap of between what we're seeing in that $1 trillion market value to about $820 billion in the Taiwan listing there. But Morningstar, for one, saying that, yes, this $1 trillion milestone is a feat, but there's so much ahead when it comes to tech advancements extending at least into the 2040s.
And it's really interesting because you see the divergence of what's happening perhaps with this stock and what's happening across Japan and its chip stocks. Many of the big names, including Tokyo Electron, are trading sort of sideways after hitting those highs earlier this year. Let's bring in our tech reporter Annabelle Drulers to discuss why. Annabelle, what's going on here?
Yeah, well, it's been a really interesting phenomenon, as you said, that sort of underperformance we've seen in Japanese chip names versus some of their more global peers, and why they're looking vulnerable in particular. What we are seeing in Japan is just a huge amount of margin buying, particularly among retail investors. So what happens is you're pretty bullish on the outlook, you don't have quite enough cash, you go to your bank or your broker, you give them some cash, and then they top up as well. Standard procedure, of course. It's become extremely popular in Japan. You can see in this chart, we haven't seen this level of margin buying going all the way back to 2006. But what happens then is you have an extra element of vulnerability because, of course, if the market weakens, then investors need to close out their positions, and that can lead to further selling pressure and so on. That's the trend that we're seeing in Japan, most acute in the tech sector. In Tokyo Electron, you mentioned, actually that's had a nearly $300 million increase in margin buying just since the end of last year alone. That is the most that we're seeing for any company on the Topix 500 index.
As you said, most acute, but are we seeing other sectors that are being impacted by this as well?
Yeah, well, we often talk about sort of the picks and shovels in the AI trade, things like utility companies, infrastructure providers, things that are going to build the data centers. That's where we're actually seeing a lot of the margin activity in these sort of second order areas that are sort of adjacent to chips. So names like Tokyo Electric Power, Hokkaido Electric Power, for instance, they're both seen to pick up in positions. I guess the question as well is how much does this really matter and what's going to be the bigger impact? And some of the analysts that we're speaking to saying we could start to see some sort of impact once you get those earnings coming out. They're just around the corner, how positive those outlooks are. Of course, what the BOJ does, because if they do hike rates, even 25 basis points, that increase the cost of buying on margin. These are all sort of the things that we're still yet to see as yet.
Another tech company we're watching is in South Korea, Samsung. How's the strike and the labor action that we saw in that company going at this point?
Yeah, well, it's going into its second day. We know this strike is supposed to be taking place Monday, Tuesday, Wednesday of last week. So we saw people turning out yesterday, striking in front of the company's chips headquarters. Actually, more people than expected turned out for this. So the company, or the union rather, had been tipping around 5,000 people to turn out. Around 6,500 people came out instead. The company, or the union rather, is saying that it is going to be disrupting chip production. Analysts we're speaking to saying maybe not quite yet. This strike was very well scheduled or well signaled. A lot of the chip production is automated as well. Still, though, that's certainly something we're going to be tracking today. Do we start to get any further commentary? And what's also the turnout this morning, Heidi?
Annabelle Drulers there in Hong Kong with the latest. We're staying with tech, and today's Big Take takes a look inside Elon Musk's SpaceX, with former employees telling Bloomberg Businessweek about the frat house culture infused with casual sexism. And, Shery, we were both reading the story earlier, and it is just quite a story.
Last month, apparently 8 former staff filed a lawsuit in California that accuses SpaceX and Musk of sexual harassment and whistleblower retaliation. Our senior reporter Josh Adelson joins us with more. And Josh, as Heidi mentioned, we're really shocked at this story. What did these fired SpaceX engineers tell you about what's happening at that company, and how much really does this have to do with Elon Musk himself?
People who worked at the company say they were subjected to an environment that, as you said, was like a frat house, that was characterized by sexual harassment, by conduct including men saying that women were biologically incapable of being engineers or staring at their chests or making crude jokes that mimicked the tweets that Elon Musk was posting online. For example, when Elon Musk posted about a fictional university with an acronym about women's bodies, there then were men musing about which women that worked there would do well at that university. And those fired workers allege that because they did an open letter calling on the company to evenly enforce its policies, to put its culture in line with its official standards, they were fired in retaliation, that the company chose to go after people calling out misconduct and harassment in the company rather than people perpetrating it.
What's also extraordinary is the way that SpaceX has responded, right? Trying to get the Labor board itself ruled as unconstitutional. There's a great quote where someone says, you know, just because you sort of pound hard enough at the table doesn't mean you can stop a federal body from functioning. But in a lot of ways, is that exactly what's happening?
So as a reporter at Bloomberg, I have covered conflicts between the U.S. Labor Board and a number of the most famous, powerful companies in the country. What is different here is that when the U.S. Labor Board, which is responsible for enforcing not just the right to unionize, but the right to take collective action in the workplace, began prosecuting SpaceX over these workers' firings, SpaceX responded by suing, arguing that the Labor Board structure is unconstitutional. Other companies have taken up the same arguments, and that legal offense, this belt and suspenders and flamethrower approach that Elon Musk's company has taken, has put the government on defense, has led to the Labor Board's case against the company being frozen on hold, while at the same time, the company's case is proceeding and could change how labor protections are enforced throughout the U.S. economy.
Arguably, NASA could and should be holding SpaceX to account for this, or is this a sense that SpaceX with its budget versus NASA's budget is just too indispensable?
It's been interesting to see how SpaceX has repeatedly brought up its role as a federal contractor when it makes arguments in the litigation. And these fired engineers argue that the government should do more to hold its contractors accountable. NASA and the Space Force did not want to speak about SpaceX specifically. They, at NASA, did say that they are committed to a safe environment for their contractors. SpaceX, meanwhile, has denied wrongdoing in the litigation.
Bloomberg senior reporter Josh Edelson with this amazing story about corporate culture at SpaceX. As you mentioned, SpaceX has denied any wrongdoing and did not respond to our inquiries for the story. You can read more on this big take story on the terminal and on Bloomberg.com. We have more ahead. This is Bloomberg.
If it feels like the busiest place in the world right now in Japan, in Tokyo, I'm probably not far from being right in terms of just the influx of global tourists that have arrived here. Obviously, the weakness of the yen is one factor, but that pent-up post-COVID travel interest in Japan seems to be showing no signs of abating. And, you know, the government seems to be a little bit worried about this.
In the past, when I first entered Japan, and this was for the first time in 10 years, and I lived in Japan for 5 years, I never saw those lines at the airport. I was really surprised. But the way that Japan is handling the inflow of tourists, well, that leads to more questions about what happens next, right? Some people are talking about charging foreign tourists 2 times, 3 times, even 6 times in some parts. Some tourists have been really banned from parts of really attractive areas, districts that tourists like to go to. So really raising key questions about the viability of Japan being a tourist destination in the long run, I think.
Yeah, you've seen this with other countries as well, like New Zealand, for example, that want to kind of protect their cultural heritage, their natural heritage. It's a hard balancing act, right, because we know that the tourist spending is great for a society that's both aging and shrinking. but a lot of locals are getting quite upset about it as well. So we've also seen this in Australia as well, of course, another popular tourism destination. The travel and tourism industry has reportedly seen the highest spending levels since the start of the pandemic. The government agency Tourism Research Australia says international visitors there spent almost $7 billion between January and March of this year. And we're seeing some data showing that the contribution of tourism is to the broader economy is set to hit a record high this year as well. Let's get some more insights now. I want to bring in Tony Lucas, who's a president of the Australian and International Pilots Association. He joins us now from Sydney. Tony, great to have you with us. So how would you characterise, I guess, the period that we're in now? It's well out of COVID, but clearly in a lot of these markets, including here in Japan, and I think in some parts of Australia as well, we're still seeing that return of the post-pandemic visitor.
Yeah, certainly there's a lot of visitors and travellers at the moment, quite a lot of demand, and I think the aviation industry is probably still struggling a little bit to recover from the COVID time. We saw a lot of staff leave. We're trying to bring new staff in. They're not as experienced as the staff that we've lost to the industry, and certainly with the loss of a lot of pilots throughout the industry as well, there's some bottlenecks in the training system trying to get pilots into the correct seats on aeroplanes, lots of promotion, which is fantastic for pilots, but it does create a bottleneck and some delays and some issues with trying to get pilots where they're supposed to be to operate services.
How does this compare really with what we're seeing around the world? Because we're also hearing about shortages of air traffic controllers happening in Australia. We don't hear such stories too much when it comes to other regions as well. What's the difference here that might be the case for Australia that's impacting this more in the industry?
Yeah, I think there were some decisions made during the COVID time about the number of air traffic controllers that were required. A lot of senior and very experienced air traffic controllers took redundancy packages and haven't returned yet to the industry at all, or they've moved on to other things. To train an air traffic controller is quite a long training pipeline. It's 9 to 12 months, depending on the type of controller that they're going to be. And that means there's large swathes of airspace around Australia that are closed at various times of the day, or particularly overnight. And that causes aircraft to be rerouted, or it causes delays for aircraft at places like Darwin and Townsville on the weekend, or Darwin overnight, particularly where there's no air traffic control. And that creates some operational risk for the crews operating in and out of those airports. Why is it different to Australia? I think it comes down to the decisions that have been made about how many air traffic controllers were needed during those COVID years.
Right. Is skilled migration not one answer to this?
I think skilled migration is a potential solution, but I think with Australia's air traffic system being slightly different to the rest of the world, it still takes a long time for a controller, even if they're skilled overseas or have skills and capabilities that they bring from a foreign jurisdiction, they still need to learn the Australian way of doing things, and they still need to learn about the peculiarities of the airspace that they're controlling or the actual airport that they're controlling. And each airport tends to have slightly different procedures that require a fair bit of learning.
It feels from a layman's perspective that the industry, pilots and staff are dealing with myriad unusual challenges at the moment, right? From climate changes potentially creating more turbulence, for example, from still the long-lasting impact of COVID staffing issues. Do you think all of this is really creating more risk of safety concerns?
Well, I think one of the things is aviation is probably the ultimate team sport where you've got a myriad of different teams that come together to deliver a safe outcome. And one of the things that we find is when those teams become less experienced or we're short of staff in those teams, it creates an operational risk at other parts of the aviation system. And ultimately that risk is one that is borne and managed by the pilots. And so when there are parts of the system that aren't functioning as they should, when aircraft are running late, when there's not enough ground staff to load the aircraft, when there's not enough air traffic controllers. That all comes together to increase the complexity within the environment, and that requires ultimately pilots to try and manage that operational complexity. And so we're quite adept at that. We're trained to do that. But when you're doing that frequently and when you're doing that on every flight, it decreases our capability to manage the unexpected or to manage the errors that others might make within the system, which are ultimately upon the pilots that we need to manage.
I was going to ask, how have passenger behaviors changed since the pandemic? Are you seeing, for example, the perception of these delays, of those normal procedural issues? How tolerant are they now?
Yeah, I think one of the things that we are dealing with is that as passengers have come back with a vengeance, thankfully, into the travel industry, I think there's a higher expectation now of service. And so you've got a higher expectation of passengers who were pent up for a couple of years, and they're now travelling more frequently, and they have a higher expectation of what they expect. And they've come into an aviation system that's not as resilient as we were pre-COVID, where the teams aren't as well trained as what they were, or they're not as well experienced as what they were. And so now what we're finding is our ground staff are having to deal not just with an issue of delayed flights, but they're trying to now manage passenger expectations, which have increased considerably, and passengers being unhappy with it. So it creates a double-barreled scenario where we have less experienced staff trying to deal with complex situations and now higher passenger expectations about how those delays should be managed. So it's a tough combination.
Does that almost... Yeah, and then does that then kind of create the cycle where it diminishes the appeal of working in this industry? I look at some of these scenarios and think, why would someone, particularly perhaps a young person, want to opt to enter that sort of stressful cycle?
Well, I think there's a few things to unpack with that question. I think, as we've seen increased outsourcing, and so no longer necessarily workers aligned with their employer. They're employed by a third party and don't actually, when they work at the airport, they're not actually employed by the airline, or when they're loading aircraft, they actually don't have the same loyalty to the airline as they used to. A lot of the time we've seen them driven down onto lower or casualised type conditions. And I think for smart young people, particularly when they look at the piloting profession, they look at the barrier of entry, which in Australia is somewhere north of $150,000. And the first year income for a general aviation pilot will be somewhere lower than $50,000. And they just look at that and go, that's not worth my investment. There are things that I can invest in for myself that will give a much higher return. And so we're seeing a shortage of pilots right across the industry, but particularly at the entry level, particularly at the regional airline level, where there are just not enough people coming through the pipeline due to those higher costs of entry. And certainly the job is nowhere near as glamorous as it was 29 years ago when I started in it.
Tony Lucas, good to have you with us, President of the Australian and International Pilots Association there. And another story that we're watching on air travel, United Airlines says another of its Boeing aircraft lost a main landing gear wheel while taking off Monday from Los Angeles. No one was injured on the flight that landed safely in Denver. The incident is similar to one aboard the United flight in March, which helped trigger a federal safety review of the carrier. Meanwhile, Boeing is said to be in talks with the U.S. Defense Department to preserve its government contract business. That's after the company pleaded guilty to a criminal charge tied to 2 fatal crashes of its 737 MAX jet. We have more ahead on the Asia trade. This is Bloomberg.
Bridgewater co-CIO, Greg Jensen says he expects AI to help boost human investing over the next 5 years.
He spoke with us after the hedge fund firm launched a $2 billion fund that uses machine learning as a primary basis for its decision-making.
When we think about it from a pure alpha perspective, most of what we built up at Bridgewater is an expert system based on everything we've learned over the 40 years, mainly on how economic cycles work. And big productivity miracles are pretty separate from economic cycles. So when you look at what we're doing at Pure Alpha, we're generally trying to make sure we don't have too much exposure to whether the productivity miracle works out or not. So when we trade U.S. equities, we trade them kind of with AI hedged, because the pressures, the normal cyclical pressures will play out on the regular companies. And when you look at U.S. stocks, it's kind of the regular companies that we'd say are pretty expensive relative to the rest of the world. Mediocre companies in the U.S. have a U.S. premium in them relative to the rest of the world. Now, the great companies in the U.S. are the companies hitting the cutting edge. That's a different story. And it's very different than 1999, 2000. I've been at Bridgewater for 29 years and having lived through 99, 2000. That bubble was all about future expectations. Most of what's priced into equities today actually would say are based on what's happening right now. I mean, what's happening with NVIDIA's demand is incredible, and whether it's slightly overpriced or slightly underpriced or whatever, it's a close call. This is not like the 99 bubble, at least in my view, because the earnings for those companies are actually there in a way they weren't there for a company like Cisco in 1999. So there is a big difference. Now, you still need those earnings to be sustainable, which requires a continued growth in those areas, but not an outlandish one. And that really comes to what internally. So we need to understand AI from a macro perspective. And then we need to understand it from as a user, a micro perspective, right? That in our IA labs, which is 25 people we set aside at Bridgewater, fully focused on using machine learning for everything you need to do to invest in markets, that group, we're hands-on. We see both the problems. There are many problems. The language models off the shelf have many problems with them. But if you can combine them with data models, you can create this incredible strength. And right now, I expect over the next 5 years, so much of what human investors and analysts can do can be better done with machine intelligence. And that's been a journey for me. I've been looking at this for, Bridgewater's built an expert system based on human intuition being translated into algorithms.
Right.
For AI, having machine learning generate the ideas, generate the algorithms. That's been kind of a dream for me. And the technologies really came together in 2022 or so, that the pieces came together such that I thought we were ready to build an artificial investor. And we've moved down that track at rapid rate.
That was the Bridgewater co-CIO Greg Jensen there speaking on the debut of Bloomberg's Open Interest. Taking a look at the oil, trending a little bit lower at the moment, but of course we're heading into the opens in Tokyo, Sydney and Seoul. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And of course, we had another session high for Wall Street, but a little bit of caution as well. Of course, we have Chair Powell speaking in Congress, not to mention earnings as well.
Yeah, and we are also watching for the BOJ's discussions. We kick off today with bond traders, kind of testing the waters, I guess, in terms of how quickly they can move without creating too much of a market ripple.
I mean, given that the last BOJ meeting, we're expecting some more details when it comes to the reduction of debt purchases, and we didn't get them because they wanted to have these conversations with the market. So we'll be watching out for the results of those as we continue to watch, of course, the Japanese equity markets. Record highs has been sort of the trend recently, but we have seen a little bit of pullback this week, down for 2 sessions for the Nikkei. And the topics, of course, hit that record high last week. But it's, of course, all about the Japanese yen, because we have seen a little bit of strength this week. We're still holding at that 160.86 level, and the 10-year yield rising in the previous session as well. Really a result of the calculations that the Fed may be able to cut sooner than expected, given the soft jobs numbers that we saw on Friday. Take a look at how the Kospi is also coming online, because we're watching Samsung Electronics very closely in South Korea. Of course, workers walked off the job on Monday, and that continues throughout the week. The Kospi is gaining 0.5% at the moment. What we were watching also is the bond space for Korean 3-year benchmark bonds rising to that 2-year high. We'll be watching unemployment numbers out of South Korea. And of course, the biggie is the Bank of Korea rate decision, although, Heidi, we're not really expecting much this week.
No, and we do also have the RBNZ, I should mention as well. Not expecting much. That hawkish hold is expected to come through when it comes to New Zealand's central bank, despite these signs of a deepening economic slump there. It is becoming to be a tale as old as time with a number of these major economies at this point in the cycle. But let's get you straight to the Open. The staggered Open here in Sydney, we're seeing some modest upside there. And perhaps some more interesting stories, really what we're at with the Aussie dollar, 67.45. So seeing further resilience, we're seeing this kind of gravitational pull of the Aussie dollar at the moment on the growing prospect of Fed rate cuts and the potential for a hike in Australia instead. So that fall in volatility, the Euro pessimism kind of enhancing the allure of the Aussie. Remember, for the August RBA meeting, we're seeing market pricing at about 40%. And as you mentioned, we've got Fed Chair Powell's comments, the pressure that is under for lawmakers. So watching treasuries very closely as well.
Which is one reason we saw the dollar gaining ground in the overnight session against G10 peers, right? Let's bring in our next guest who expects that strength to continue given the upcoming U.S. elections as well. With us now is Sharma-Ong, head of multi-asset investment solutions for Southeast Asia at Aberdeen. So great to have you with us, Ray. But if we continue to have dollar strength, what does that mean for equities across Asia? Because are we going to see the impact and the downside risk for markets in this region?
So if dollar strength is to be moderate, I don't think there's going to be really significant impact on equities. We've already seen dollar strength moderately increasing over the past few periods, and we've really not seen a big derail onto equity markets in global markets as well as in Asia equity markets. However, dollar is seen as a key diversifier. In our view, there is a scope for further dollar strength. The Fed is definitely not in the current cycle where it is like in previous cycle. We actually expect the Fed to be one of the latest in terms of cutting in Q4. If you compare that to maybe where the ECB is, our projections would be the ECB will likely be the ones to cut first. And you've mentioned election risks. We do see election risk as a key risk for the dollar. From previous cycles in 2018 and 2019, what we've seen is for trade and tariff risks, if the US were to impose a certain level of tariff against a counterparty country, the dollar tends to strengthen against that country. So that would be further down the road in terms of risk to watch. But in the immediate moment, we think it is all right.
Why are you shorting the yuan? Is that factoring in strength in the US dollar? Because at the same time, you're cautiously optimistic about equities when it comes to the Chinese markets.
Yes. So for the yuan, the CNH or the CNY, firstly, the yuan is really a good funder right now. If you do short it, you get very positive carry. Secondly, there is a big push by Beijing and the central government to want to help the economy. So on that end, we do expect actually interest rate differentials to widen. We actually expect triple rate cuts from the PBOC sometime in the third quarter relative to the Fed. That will likely be on hold on the end. And given the Fed outlook in this case, we actually do expect the rate dispersion to widen even further on this end.
Ray, I wanted to dig a little deeper into what we're seeing with China and Hong Kong stocks. We're seeing the biggest losing streak for China in about 14 years. We're seeing the sort of cusp of a correction now in Hong Kong as well. So what are you, I guess, tactically overweight on if you are being selective in these markets?
Yeah, so where we are focusing on would be more China and Hong Kong offshore stocks as opposed to onshore stocks. Well, if you to rewind the clock back, in April and May, we had really strong rallies in the Chinese and the Hong Kong market. And we saw a little bit of that give back in June as investors rotated to Korea, Taiwan, as well as India. But looking ahead, we do expect certain policy announcements to be key signposts to watch that will determine whether to go further in or to go further long in this. Three things to just highlight. The Politburo meeting at the end of this month. I think we're going to try and see and read between the lines to see whether there will be any incentives to increase policy stimulus to help the cyclical position which China is currently in. And obviously next week, in the mid of July, we have the third plenum So we're going to focus a lot more on whether there will be any reform agendas being introduced. If yes, it would likely help to support the market even further or lead to it bottoming out and rebounding. And the last thing would be whether the Third Plenum would address some of the geopolitical dynamics between US-China. If it is, then we would at least have the expectations that there will be some discussions and preparations on the end, which would be positive for the narrative going forward. But definitely prefer offshore China than onshore China.
Yeah, it's interesting because a couple of the risk horizons that you've mentioned can be quite difficult to quantify, right? Plenum policy announcements as well as geopolitics as we head into November as well. So, what would be the best case scenario, particularly if you take a look at the announcements that you would want to hear from leaders going into the plenum?
Yeah, so what we would likely look for would be if there is any announcements on wanting to deal with onshore domestic China issues. For example, any issues pertaining to how to deal with the current deflation trend, any stimulus to help falling demand, or the weak confidence among local entrepreneurs on their end. In addition to that, what we would also like to see, if you extend from the Third Plenum to the Politburo, will be to want to see if there's any stimulus package to help with the macro momentum at the current juncture. Macro momentum in China definitely is slowing. We currently see it down on a quarter-on-quarter basis from about 7% down to about 3.5%. So we would actually like to see some form of support on the end that could potentially help this further.
Ray, given the political and macroeconomic uncertainties, we have seen some of those big players, basically the Magnificent Seven, at least in the U.S., see an incredible rally on the back of that exuberance over artificial intelligence. Are there any stocks or sectors across Asia that may be a similar play for investors?
Yes, so within Asia, we do like the major trends in AI and tech build-out, mainly the biggest names in Korea and Taiwan. Individually, they already post the biggest earnings growth for this year, and we actually see them validating on that end. The structural trend of AI adoption in Asia, for example, Korea and Taiwan are the biggest parts of the value chain. Korea is the lead manufacturer of high bandwidth memory chips, which are actually needed in the AI build-up. And Taiwan is the leader in semiconductor manufacturing, which will also be required. So if you combine these two, we do think these two will be beneficiaries in the AI adoption trend.
Ray Sharma-Ong, head of multi-asset investment solutions at abrdn, with his take on the markets. And we're just discussing the tech sector across Asia. Take a look at how chip makers across the region are trading right now. Of course, we continue to watch the risk around Samsung Electronics and that ongoing labor action, the biggest in the company's history. We're still seeing the stock up 0.6%. Competitor SK Hynix is also gaining ground. We've talked about a little bit of risk when it comes to Tokyo Electron, given the margin buying that we've seen in this Japanese company, the biggest increase among companies on the Topix 500 index, given the exuberance over AI. We still see it gaining more than 2% at the moment, Heidi.
Yeah, one of the stocks we're watching in Sydney is Babcock. This is the automotive parts company there, which is the parent company of Autobahn in Australia. And we did have a bit of deals activity coming through. The retailer really rejecting that $1.2 billion takeover offer from Bain Capital as being too low, saying that $5.40 Aussie per share cash offer doesn't represent fair value, isn't in the best interests of its shareholders. And we are seeing a little bit of further decline there. We've seen quite a significant drop there for that stock, down about 50% from their high in mid-2021. There's been a series of difficult and challenging headlines from profit downgrades, struggles of inventory. We also saw that preemptive departure of their CEO-elect as well. But we'll be watching to see if Bain comes back for another attempt there. More ahead on the Asia trade. This is Bloomberg.
The bottom line here is that we're not going anywhere. I am not going anywhere. I wouldn't be running if I didn't absolutely believe that I am the best candidate to beat Donald Trump in 2024.
President Biden there pushing back on calls for him to quit the US presidential race, and the president is working to quell Democratic infighting about his campaign, writing a letter to lawmakers and speaking with his financial backers as well.
Bloomberg managing editor Derek Wallbank is following all of the developments, and Derek, of course, the key question is whether we'll see really a drawn-out power struggle in the Democratic Party. How big of a risk is this headed into election season?
Well, Shery, Heidi, I think the word of the day for Joe Biden is defiance. It's, I've said multiple times since that debate on our air that Joe Biden really holds the keys to who is the presidential nominee for the Democratic Party. He has an overwhelming lead in the delegate share. He won 87-ish% of the vote in the Democratic primaries. He is the incumbent president. He has a war chest of some $240-ish million to campaign, and he made all of those points in a letter to Democratic lawmakers overnight our time. He basically is in a situation, as we've said, where he is the guy who controls it. He is the guy who decides whether or not he steps down, and right now he is saying, I'm going to be the nominee. Whatever you need to do to express your feelings and get that out, fine, but we're moving forward and I'm the guy. So at some point, Biden is trying to convince Democratic lawmakers that there is no off-ramp, that he is not going to take any off-ramp, and so their option is him or Trump. It's binary. Get on board and get in line. Now, will that work? That is a key question. I think what you have seen so far as Democratic lawmakers came back to Washington is you've seen, yes, there are some who have sought for Biden to go, but overall, the people in the large power centers, your Hakeem Jeffries, your Chuck Schumers, your Jim Clyburns, who Biden listens to, have all been very much on the we're with Biden group, right? They have not gone away. And I was actually interested to see that just a couple minutes before I came on, some members of the squad, your AOCs, your Ilhan Omars, people like that, are standing with Biden and saying, yeah, he's the nominee. This is the guy we're going with.
Interesting you say binary, because part of that argument is that it's too late. We don't have enough time before November to be able to reorganise this. I've seen some commentators say, look at what the French left have just done, right? Is there kind of a lesson to be learnt there in terms of the frenetic, purposeful reorganisation that we saw for that movement? Could that happen in the US, or are we comparing apples and oranges?
Well, there are some of us who have covered U.S. politics for a long time that wish that election cycles were 3 weeks and not 3 years. But that's, the American system is a very different system. But what I will say is this. Mechanically speaking, and I love to run out the scenarios here, mechanically speaking, there actually is time. There's not much. There's weeks, not months. But there is time if Democrats were going to do something to shift from Biden to Kamala Harris. The difficulty is at this point is that all of the primaries are done, right? The delegates are apportioned, and the delegates who Biden has claimed from winning all of these states are Biden people. They are Biden loyalists, right? And so you would have to convince these Democratic delegates to set aside the result of the primaries and go with somebody else. That person, as I say, would most likely be Harris in that scenario. So yes, it is metaphysically possible, but for a combination of influential people sort of staying on the sidelines, Biden not wanting to move, it's not something that right now is moving forward. Now, that having been said, a couple more events like that debate that we had, maybe the ground shifts and that's different. I'm not going to say never, but I will say that time is running very thin to do so. The person who gets to make the call is at this point Joe Biden, and Joe Biden, as I say, was pretty clear about where he stands right now. Let's see how this week goes, but the time to make a move is narrowing quickly.
Managing editor for Breaking News in South Asia, Derek Wallbank, there with the latest, of course, on that presidential election in the U.S. We do have other political developments that we're following. The left-wing alliance that won the most seats in French parliamentary elections says it will nominate a prime minister in the next few days. Sunday's vote produced a divided parliament with no clear majority. The left's candidate for premier will almost certainly need to win support from President Emmanuel Macron's group, which won the second biggest number of seats.
Hungarian Prime Minister Viktor Orban has met with Chinese President Xi Jinping during an unannounced visit to Beijing that followed a similar surprise trip to Moscow for talks with Vladimir Putin. EU leaders have sought to distance themselves from Orban's shuttle diplomacy, which comes as Hungary takes over the bloc's rotating presidency. Orban heads to Washington this week for the NATO annual summit. Take a look how European futures are tracking at the moment. This is a picture when it comes to Stoxx 50 futures. They're a little bit softer across the board, really. German DAX futures also looking pretty flat at the moment. We're actually the euro there as well, seeing a little bit more of a rebound, sort of some resilience returning to that trade as we get a little bit more clarity in terms of what that picture of government will look like for France as well. But of course, as we mentioned earlier, we're heading into that NATO summit, so geopolitics will continue to dominate that narrative. We'll be watching that very closely there as well. We're also hearing some commentary about the situation when it comes to the ECB, when it comes to these rate cut expectations as well, investor expectations to loosen or to cut once or perhaps twice more this year, looking quite possible with the expectation that maybe inflation and growth will develop as expected. That's according to one of the Governing Council members there. More ahead on the Asia trade. This is Bloomberg.
You're watching the Asia Trade. Microsoft has told employees in China that starting September, they'll only be able to use iPhones for work, effectively cutting off Android devices.
Our China correspondent Min Lo joins us now from Hong Kong with the details. So, what prompted this move from Microsoft?
Yeah, it's really part of a security upgrade that Microsoft is embarking on. It is now requiring employees to bring iPhones to work because they need the Microsoft Authenticator app on the iPhone. It's only accessible via the iPhone's App Store now, and that's because Google Play, the Android App Store, is banned in China. And this really speaks to the challenges that Android phones face in the Chinese market, given this growing split between the Chinese and global mobile ecosystem, with Chinese phone makers like Huawei and Xiaomi using their own platforms to host local apps. And this comes as Microsoft is hit by a series of rather embarrassing hacks. In January, there was a Russian-linked hack that was discovered that had infiltrated several dozens of U.S. government agencies. And in May as well, a Chinese-linked hack had allegedly stolen Microsoft's Access tool to break into the email accounts of high-level U.S. officials. So Microsoft has been under tremendous pressure by U.S. legislators, some legislators saying that its security system is shambolic. And so Microsoft is now embarking on this ambitious security overhaul to really enforce this multi-factor authentication for employees, to make it harder to steal employees' identities and to really shore up security of its cloud computing system as well.
Min, this also at the same time puts a spotlight on the iPhone, right? I mean, it's getting banned in some organizations across China as well.
Yeah, more and more Chinese government-backed firms and agencies are said to be ordering employees not to use iPhones or other foreign-made devices like Samsung as well, out of national security concerns. Now, it's not clear how widespread this practice is and how strictly it's being enforced, because some of these directives came through verbally and the Chinese Foreign Ministry has pushed back against some of these reports. But it does speak to this growing geopolitical tensions and national security concerns that China and the US have of each other. And in May as well, the Wall Street Journal had reported that Microsoft was offering to relocate over 700 of its employees in China who work in the AI sector, mostly engineers who work on cloud computing and machine learning. And of course, this is an area where China and the US is locked in this battle for tech supremacy as well.
Bloomberg's China correspondent Min Min Lo there with the details. Some of the other corporate headlines that we're tracking this hour. United Airlines says another of its Boeing aircraft lost a main landing gear wheel, while taking off Monday from Los Angeles. No one was injured on the flight that landed safely in Denver. The incident is similar to one aboard a United flight in March, which helped trigger a federal safety review of the carrier. Meanwhile, Boeing is said to be in talks with the US Defense Department to preserve its government contract business. That's after the company pleaded guilty to a criminal charge tied to 2 fatal crashes of its 737 MAX jet.
Chinese EV maker BYD has signed a deal with Turkey for a $1 billion factory. The company wants to produce 150,000 electric and hybrid vehicles each year in the plant, which also includes a research and development center. The move could bolster the Chinese automaker's foothold in Europe. Turkey is not an EU member, but has a customs deal with the bloc. Take a look at how U.S. futures are setting up at the moment after we saw another record high for Wall Street, the 35th this year already, of course. There is a lot of optimism around artificial intelligence, also about expectations of 2 Fed rate cuts, but at the same time, a little bit of caution in the markets, given that we are headed towards the start of the earnings season and we're awaiting Chair Powell's testimony to Congress. What I'd be personally watching, Heidi, is what he says on the labor market, not to mention, of course, easing financial conditions.
Yeah, and all of this, Shery, is weighing on the picture when it comes to risk for commodities as well. In particular, I'm watching iron ore. We're continuing to see some of that weakness on a longer-term basis play through. A bit of a rebound when it comes to Singapore-traded contracts, about 0.3%. But, of course, we're coming off a situation where we have Chinese port inventories at the highest in about 2 years or so. We're also seeing some concerns that perhaps China's plenum won't necessarily deliver the growth promises that investors are looking for. So these cues affecting both bulls and bears across commodities. The power grid could be a focus to benefit solar and copper in particular. We're seeing copper trading pretty flat at the moment on the LME. Oil refiners won't be welcoming any measures when it comes to EVs and taxation. So those are the things we're looking for. We're seeing Brent crude also trading pretty flat. Unsurprising, Shery, given a number of things on the risk horizon today.
Right, including, of course, economic data later in the week as well from China, CPI, PPI, deflationary trends continuing, especially in those factory gate prices. And we are expecting that growth in China's exports to continue, but we may get a picture of external demand, which appears to have softened slightly. So we'll be watching for those numbers out of China later in the week as well. We have more ahead on the Asia trade. This is Bloomberg.
We are just getting Westpac consumer confidence numbers for Australia, and this is the picture. We do have that decline of 1.1% month on month to 82.7. We're seeing a improvement when it comes to consumer sentiment, actually, of 1.8% year on year. Family finance, that picture deteriorating by almost 8.5% month on month versus the year ahead, also seeing a fall of 4.5%. And expectations of the economy 1 year ahead, interestingly, seeing an improvement of 3.6% month on month. So clearly a lot of holding out when it comes to hopes or expectations that the RBA will perhaps over the next few months finally come through with some easing, although of course pricing in these markets for the August meeting continuing to sit at about 40% for the risk of a rate hike from the RBA, given that we have seen that stubbornly resurgent inflation picture there as well. But we have seen really the underlying weakness for the Australian consumer start to play out, given the cost of living crisis and really the increasing prices of just about everything.
In the meantime, Australian stocks, though, pretty resilient. We are seeing those gains across the board in all sectors, including communication, materials and real estate sectors leading the gains today. But it's really all across the board, across Asia as well, because we're talking about the Nikkei hitting that new record intraday high, gaining about 1%. We have seen a little bit more strength and stabilization on the Japanese yen, but it's really about those stronger than expected wage numbers that we got earlier in the week and the potential that the BOJ might lift interest rates come July, later in the month. The Kospi is also gaining ground despite the fact that we're seeing a little bit of risk around the labor action in the Kospi's biggest stock, which is Samsung Electronics, of course, and as you can see, the ASX 200 gaining 0.7%. But we're watching political risk, Haidi, of course, with also the Indian Prime Minister in Russia.
Yeah, this is such an interesting relationship, and as we were talking about, also an awkwardly timed visit as well ahead of NATO, right? Indian Prime Minister Narendra Modi has met privately with Vladimir Putin to begin his first visit to Russia since the outbreak of the war in Ukraine, and it comes as Moscow is deepening its embrace of India's rival, China. Joining us now for analysis is Swasti, who's the Associate Fellow at the Manohar Parrikar Institute. This is a think tank funded by the Indian Ministry of Defence. Swasti, really great to have you with us. And so what are you watching out for in this visit? Because we know from the outset there's probably not going to be major deliverables. It's very interesting to see the aspect of how China in the background plays into this, given that no limits friendship that we've seen reaffirmed recently between Moscow and Beijing.
Yes, a very good morning to both of you there, and pleasure to talk to you. Yes, I think when you look carefully at what is happening, I mean, on the one hand, of course, it is all about India exercising its multi-alignment in national interest, and that is something which is very, very evident. But if you sort of observe it a little more closely, what you see is that since February 2022, the political interactions between the two sides have been seeing a bit of a transformation. So, for example, the only personal meeting between Modi and Putin in the months that followed, the war, were actually only held at the sidelines of Shanghai Cooperation Organization in Samarkand in 2022 September, and then the leader summit was postponed, etc. Now, what we are looking at right now is that there are a couple of things that we need to get going, because there are certain political dialogue mechanisms that the two sides had set up that have not really been able to develop, and one of them is basically the 2+2 dialogue. If you may be aware that India engages into the 2+2 dialogue with a lot of its close partners. So, for example, the Quad countries, Japan, Australia, US, and India, they have a mutual 2+2 mechanism. Similarly, we have a 2+2 mechanism with the UK, and we had also started a 2+2 mechanism with Russia. But the only meeting, the first and the only meeting, happened in December 2021, and we have not really seen that happening. Now, then last time when the two leaders met, this is 2021, we also signed on the 10-year defense cooperation program. But if you actually see the real progress, you will see that it's also been in a limbo. So cutting a long story short, I think what I want to underscore here is that, of course, India and Russia have had a historic relationship. Of course, India and Russia have had a very stable relationship, in that sense. But the war in Ukraine has also brought about this transformation, the geopolitical churning. And if the two sides need to evolve in a constructive manner, I think they need to enable frameworks. And one of the ways to do that is to actually get all the established mechanisms working. Because so far we have seen the NSA level dialogue, we have seen lone visits by the two foreign ministers. But I think this particular visit by Prime Minister Modi was long awaited, because we need to really resolve certain issues that have come up after the war in Ukraine.
So, I wanted to focus on the trade imbalance, because it is quite the imbalance. India purchases about $60 billion worth of goods from Russia. In reverse, it's only less than $5 billion. Is there any sort of meaningful way to be able to address that asymmetry?
Yeah, absolutely. So I have been writing about it quite a bit. And, according to my analysis and my understanding, there are imminent issues between Russia and India. Like I said, that kind of spring from the war in Ukraine and the kind of geopolitical changes. So one of the issues you mentioned out there was trade deficits. Now, of course, Russia was never really an oil exporter to India before the war in Ukraine began. That entire situation came around only because there was a G7 price cap and oil ban that made the the rerouting of Russian oil so important, and then India emerged as one of the key destinations. Now, while on the one hand, it has really sort of upped the bilateral trade. Now, the bilateral trade right now stands at about $65 billion, which is quite unprecedented in every way. At the same time, you have a trade deficit, which is $61 billion. And this trade deficit comes next to China, India-China, which is like our number one trade deficit. And also, if I recall and remind everybody here, is that the priority for Modi 3.0, because the Prime Minister has just come back for the third term, and the priority for Modi 3.0, the two main verticals out there, one is economic progress and the other is national security. So we need to reduce that trade balance. And if you can allow me a minute to speak on that, I think what we can do is that we really need to find out ways to export more to Russia. And there are certain structural challenges out there that, it's not really picking up, because in 2022, 2023, for example, we exported about $3 billion worth of goods to Russia. And now it's just up by $1 billion.
So, Swasti,
whereas the trade deficit,
we're running out of time, but I do want to get you to other relationships like Washington, because we have seen the U.S. criticize China's relationship with Russia, but really not saying much when it comes to India. Tell us a little bit about the relationship with Washington and how India is in a way benefiting from that complexity in geopolitics.
Well, yes, I think India has emerged to be one of the major pillars of the U.S. engagement and the Western engagement, if you look at how the geopolitics of Indo-Pacific has been unraveling. And I think, long story short, one can sort of argue with considerable amount of, traction that today in geopolitics, a more empowered India is in the long-term interest of the West. And all the strategic, so to say, in terms of the weapons, in terms of economics, in terms of trade and technology, all that closeness that you see between India and the West is actually a fallout of that. Now, that said, I think it is also, India has been successful in pragmatically conveying to the West that it has a multi-aligned policy and it would like to keep its options open. And what you see happening today in Moscow is directly related to that. But I think I would like to stress on the fact that everybody in India also understands that multi-alignment by itself does not mean an equal distribution. So India will operate in national interest, and multi-alignment is a means and not an end. And I think this particular visit is important because there are certain structural issues that we really need to iron out. For example, the S-400s have not really, the remaining two consignments have not been delivered to us. And so far, there has been a bit of an uncertainty because Russia has said that they will deliver towards the end of 2026, third quarter of 2026. And if you know that S-400 is an important part of our air defense program here. So I think there are these certain issues that have cropped up. And, Russia has, again, in terms of a weapons exporter as well, there's been a bit of a, I would say, limbo in that relationship, because we have not really placed any significant new orders from Russia, and everybody is seeing whether or not we are going to be placing a new one. But all of that depends on how, Russian military-industrial complex is going to perform. So I think these are issues that really require a dialogue at the highest level. So that is what we're seeing happening.
Swasti, really great to have you with us, Swasti Brar, who's the Associate Fellow at the Manohar Parrikar Institute. More ahead on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. As China's consumer recovery struggles for traction, one sector is emerging as a rare bright spot: milk tea. Now, venture capital has been pouring in, enriching some founders who started out as street vendors.
Yeah, I have to say, it's not just China. We're seeing this even in Australia as well. But let's get some views on how this kind of plays into the macroeconomy. Our Bloomberg opinion columnist, Shuli says that this craze is leaving actually a sour taste. So, Shuli, what are you seeing in the tea leaves or in the bubbles, if you will, the pearls here?
And every time there is something that's something that has a brighter outlook, what we see is hyper competition. And as of last year, there are over 400,000 tea shops across China, pulling over $30 billion a year. And you will say, okay, it's pretty good business, right? Young people associate milk tea with, not with caffeine, but with relaxation and hanging out with friends. But what happens is that, all the venture capital money and all the local tea brands, they just want to expand as fast as possible using the method of franchising instead of directly operating those tea shops. So what we are seeing is that, even though the total revenue is coming up, it's only by the number of stores. The sales per store has been coming down, and it's exacerbating China's deflationary environment. And what we're also seeing is that sorry.
No, go ahead. I mean, it's really interesting how popular these bubble tea stores have become.
I mean, and we also know young people are fickle, right? Like, I don't want to drink the same bubble tea taste every day, right? So what's happening is that all these tea shops, they are pumping out new concoctions every week, and they are looking up and down China and across Asia for exotic fruits, driving up the price of very archaic citrus fruits, like Winpro and etc. And so basically what we are seeing is hyper competition, or what they call involution in China.
Yeah, so tell us a little bit about that, because is this a uniquely Chinese problem? I mean, we have seen this hyper competition in other industries as well, like, say, EVs, right?
Right. I think, unfortunately, it's very unique to China. I mean, you can say, okay, the Chinese economy is growing a little bit slower. There are not that many good opportunities. That's why everyone is flooding into this industry. But that's not the case. Like, even during the yo-yo years of 2020, 2021, right, what we are seeing with, those bicycles, etc., I think it's just the Chinese society. There are just not that many paths to success. Like, if you look at Europe, merchants, the Medicis, they can become kingmakers. But in China, traditionally, we only had the civil servants exam, and then everybody is built from day one is built into the mindset that I just have to compete to be on top in this one industry. And I think, unfortunately, that's part of doing business in China now.
I never thought that I'd be talking about a bubble tea overcapacity, but I think that's what you're getting at, right? So are you sort of comparing this to, overcapacity in solar panels? We saw, of course, speculation in everything from pu'er tea to grave plots in China over the years as ways to make money. What's next?
I guess electric vehicle chains. I mean, you don't see Chinese companies stopping, right? Like Huawei is making electric vehicles too. Xiaomi as well. Like, why are they even in this industry? And you see that these Chinese companies, they don't like each other. They're actually going overseas to run away from each other. And then in overseas markets, in Mexico, they're running into each other again. So, I mean, in China, it's basically everyone crowding into the same industry. And then they're doing this scale it until you make it mentality. And in my view, it's very, very unhealthy.
Just like too many bubble teas, too much of a good thing. Bloomberg opinion columnist Shuli ran there. We're sticking with China, and we're looking at the impact on Nike, because that's a stock that traded at its lowest level since March 2020 on Monday, Shery.
Yeah, the U.S. retailer seeking to revive sour sales and relationships with sneaker sellers. Bloomberg Intelligence senior analyst for Asia Pacific consumer Catherine Lim joins us now. Catherine, I mean, I still love my Nike shoes for running. What's wrong here with the company, and are we going to see a turnaround anytime soon?
Right. I think the problem that we've actually seen for Nike really is that they've highlighted it. There were some issues with some of their lifestyle, portfolio, particularly shoes. So they're going to try and readjust the positioning of that. Now, as you've actually highlighted, we're seeing so many of these alternatives right now, whether it's Hoka, whether it's, on cloud, etc. So that's the repositioning that I think Nike really does have to do. And kind of like steering away a little bit from its flagship basketball selection, which then, coming back to China again, we're actually getting very, more affordable value for money, alternatives such as Anta and Li Ning.
Yeah, it's interesting because we've seen, or you've seen in your latest report, that Anta, for example, there's sequentially stronger retail sales gains in China. Does this suggest that this is the brand that can better capture the preferences? Is this about sort of nationalism or pricing advantage?
Well, I think it's really the pricing advantage that you're talking about in China. And, notwithstanding, this company is also looking to actually capture, the nationalistic, inclination of the Chinese shoppers. And they've done a good job. Notwithstanding, of course, we're going into the Paris Olympics, and we're going to actually see that coming through very strongly as the different nations actually compete, for gold medals at the Paris Olympic. And we might actually see more of that coming through, particularly since Anta is a sponsor of the Chinese Olympic Committee.
Catherine, does that mean that what you're seeing happen with Nike is not necessarily an industry-wide problem when it comes to athletic wear?
Well, definitely not based on what we've actually seen. There are selected, companies who will do better, and then some, slightly weaker. Take the case of Li-Ning, for instance. They are also having some issues of their own, which will actually come through in the first half of the year. And as we compare it with, the same period of 2023. But, others like, Anta, and you may actually get selected, niche Chinese players who may be able to actually ride on the, again, the nationalistic side of things in China, as well as more affordable products for the local consumers. And they're coming from a lower base versus Nike, and they may actually have, better numbers to actually show to the market.
Bloomberg Intelligence Senior Analyst for Asia Pacific Consumer, Catherine Lim there. And of course, be sure to tune in to Bloomberg Radio to hear more from the day's big news makers. Get in-depth analysis from the Daybreak team broadcasting live from our studio in Hong Kong. Listen through the app, Radio Plus, or BloombergRadio.com. Plenty more ahead. Stay with us.